I will go ahead and get us started here. Is this working? Okay, good. Well, thank you everyone for being here today. I am Andrew Joyner, filling in for our president, Kevin Brangers, who is out of town on business. We've got a wonderful panel lined up for you today, but before we get started, just a few brief announcements. Next couple months, do business training next week. That'll be on Tuesday and Wednesday, September 13th and 14th. I believe we still have a few spaces available, and that is an opportunity for continuing education. So please see our website to register. On September 24th, the chapter is participating with SIOR in a Feeding the Homeless project. We do have some volunteer slots still available for that, so please see myself or our admin, Kelly Mills, for more information on that. Our next chapter meeting will be held on Thursday, October 13th at the Battery Atlanta, which is the new multi-use development adjacent. That will take place late afternoon, early evening, and we will have more details coming soon on that. And of course, the CCIM Thrive Conference is being held in Atlanta this year, and with to host a networking event, which will be held at the Football Hall of Fame. This will be a wonderful evening of entertainment and an opportunity to network with over 300 CCIMs from across the country. So please see. And on Friday, November 18th, we'll be having our annual economic luncheon to be held at Cherokee Town Club. Dr. John presented the presentation to us 2 years ago. This is our signature event of the year to our businesses. And we do have some opportunities remaining for table sponsorships. So please see our Administrator Kelly or our website for more information on that. On the education side, we have 2 offerings remaining for the year. We have a 103 class to be held from September 19th through the 22nd, and a 104 class to be held from November 7th through the 10th. So please continue to spread the word on those classes. And finally, we'd like to thank all of our wonderful sponsors, including Warren Averett for this fantastic facility that we're in today, and Kelly Kitchens Gaynes for our lunch. Very, very generous of them. And with that, I would like to call on Leo to introduce our panel. How would everyone feel about a program in Savannah? And the question, you know, we try to create opportunities outside of Atlanta to reach and work and family obligations. You know, it's not always easy to make that trip. So, yeah, yeah.
Yeah.
Yeah, I don't know about that. We actually may be sending out a survey to our chapter membership on that, so be on the lookout for that. Leo, coming up.
Thank you so much. Good afternoon, everyone. Thank you so much for coming here.
We have a great program ahead of us. Bill Berg. Bill Berg has been with KKG since a shareholder practicing in the real estate group. Bill represents clients in the leasing, operations, financing, purchase and sale of retail, office, industrial, medical office, and mixed-use projects. You name it, he has done it all. Bill's expertise includes negotiating, structuring leases, ground leases, purchase and sale agreements, and loan documents, as well as advising property owners on matters such as property management, lease enforcement, construction, vendor disputes, and brokerage commissions. Bill also has a wide experience in general business and Georgia chapter, and KKG has been a very generous sponsor to our chapter, to which we are very grateful. Emory 82. When Bill is not in the office, Bill enjoys playing tennis and spending time with his wife, Carol, and with his daughters, Ellie and Erica. Please help me welcome Bill Berg.
Thanks, Leo. Thanks for everybody for being here. Thanks for CCIM for asking me to moderate today's panel on the traditionally exciting topic of strategies in commercial real estate. But you know, we have been, my law firm has enjoyed our association, our sponsorship of the CCIM program. As I was saying to Leo before, the programs at these meetings have been uniformly outstanding, and hopefully we will live up to that standard. Go ahead and introduce each of the panelists today. First, James Freeman at Strategic Group of Companies, which delivers tax efficiencies through global business solutions and private equity capital. He's also the co-managing partner of an affiliate called Strategic Capital Partners, which is a boutique investment bank focused on sustainable and socially responsible tax strategy. Hill and his MBA from Duke. Brenner. Sitting next to James is Laura May, who's cost first background commercial real estate industry. At Bedford, she works with CPAs, attorneys, and other financial advisors. She also speaks around the country real estate participants about cost segregation. Prior to joining Bedford, Laura was a real estate officer at Wells Fargo Private. She's been involved in every aspect of the real estate life cycle. Plus, Laura is a CCIM. So, next to Laura is Wayne Williams. Wayne is a tax member of Warren Averett Regional Accounting Firm and our host today. Has offices in Georgia, Alabama, and Florida. Wayne works with real estate ventures, sponsors, investors, and operators, as well as service providers to the real estate industry. Typical engagements for Wayne include planning for the acquisition or disposition of properties, including the structures, some of which we're going to be talking about today, and joint venture planning for compensation and cash flow. Next to Wayne, Bruce is a person who needs no introduction, probably because I've worked with him for 29 years, 10 months. Bruce, and I'm counting days, that's right, yeah. Bruce is both a lawyer and a CPA with 40 years of experience helping clients with their tax problems and planning opportunities. Before practicing law, Bruce worked in the tax department of a national accounting firm, what was then known as a Big A, which dates both of us probably, but his law practice focuses on estate planning, business and merger and acquisition matters. Bruce frequently speaks at continuing legal education programs for lawyers and also for non-lawyers and for accountants as well. He spends most of his, I shouldn't say most, he spends a lot of his free time working on working with non-for-profit and community organizations. So again, our common theme today is going to be tax-saving strategies for commercial real estate. We're going to start off with James and talk about 1031 exchanges, Section 1031 exchanges. James, my experience with 1031s has been one of the biggest challenges, not the only challenge, but one of the biggest challenges has always been that when you have an owner with multiple, property owner with multiple members, multiple ownership, going into the exchange, less than all of the partners, less than all the members want to actually do an exchange. Some partners want to take the cash out of the sale. Some partners want to go forward with the property. Can you talk to the group about how LLCs or partnerships or even corporations, if there's anything about corporations, that can handle this issue?
No, sure. Hello, everyone. Is this on? No? Yes? Okay.
Not yet.
The switch would help. Hello?
All right.
So first of all, I'll apologize. This is a very, can be a very complex area of tax law. And I think I've got 6.5 minutes left to talk about some things. So I really want to hit some of the highlights. Just know that we can have additional conversations one-on or at another time, because there are really many things to talk about. But definitely wanted to bring up some more current things that we're seeing today, and then get into some nuances. Because I think one of the things we see all the time is, hey, we're getting ready to sell this, it's closing tomorrow, we need to do this 1031 that our closing attorney told us about, and oh, by the way, there's 5 of us partners, what do we do? And literally we get that phone call once a week. I'll tell you that with everything related to tax, the more planning that you put into it, the better. Not always reality, but again, whatever you could do. And that's really where we will the partnership go ahead and swap properties, right? And so partnership sells a property, partnership buys the property, and then or partnership sells the property, and then as replacement property, say we have 3 members of that LLC. Well, they're going to maybe want to go their separate ways, right? Because usually if people are selling stuff, that's really they're going to dissolve the partnership, or you have 2 that want to go and 1 that wants to go off the other way. So we would set up some individual LLCs and say, okay, well, why don't you pick your replacement property, we'll acquire it in this single member LLC. The other one we'll put down here, we'll wait a year and a day and then distribute. I very rarely see that happen. What I see happen most often is literally we will drop out an undivided interest. And then they will individually exchange. So there are obviously risks associated with that. If we're going to do it 5 minutes, and do the swap and drop, the IRS can kind of come back and say, okay, well, did you really have a held for investment intent here? We think, yeah, the answer is yes. The risk is kind of low, but to the extent you can pre-plan and do that 6 months or over a year, all the better.
at the end of all the presentations for questions. So if you have questions, either write them down or remember them. One other thing, probably the other biggest issue these days in particular, is being able to find replacement property. Because you only have a limited amount of time, 45 days, to identify the replacement property, and with locating replacement properties. Recently, we've had a tax court decision last month, about a month ago, potentially opened up some opportunities in this area, as I understand it. So can you talk about this particular development, James?
Sure, as swiftly as I can. So in the intermediaries, right? We hold on to that cash, they do not, and then we supply that cash when they find their replacement closing, right? Multiple properties. Scenario. A single member LLC. We will then go acquire property because they have found what they want to buy. They just haven't sold anything yet. So, right? So we will go buy that on their behalf, and it's, from our perspective, a zero-sum transaction, right? It's often referred to as the accommodating title holder or the straw man, what have you. But essentially, we're holding title. We're leasing that property back to our client. And then, they're also paying us lease income, so we're doing a triple net lease, and the whole thing pretty much zeroes out. So we are indemnified and don't really have the benefits and burdens of ownership. So what came out a while back was known as a safe harbor. And so the IRS said, look, if you do this within 180 days, very similar to the forward exchange, then we're going to grant the taxpayer safe harbor. But what the safe harbor also means is, well, just because you don't follow the safe harbor rules doesn't mean it won't qualify. So there was a PLR that was written, a private letter ruling, where the actual intermediary, the accommodating title holder, had 5 to 10% equity in the deal. They had benefits and burdens of ownership, and they were granted. So now this case came out last month called the Bartell case, and that a little bit in excess of a year took half of the accommodating title holder. The IRS pursued them and said they didn't meet the 1031, and it was actually upheld that the taxpayer's deferral was granted. A lot of people look at it and say, the taxpayer hasn't sold anything yet, so there shouldn't be a clock that is ticking. And so we looked at that, and even though it may be overturned, there's a lot of stuff you can take away from that, right? So all these questions and discussions come up. I know for our business, I started looking at it and saying, okay, am I about to be in the warehouse business? Because I know all our clients are going to say, well, gosh, why would I ever buy anything when James and Ricky can just go ahead and hold it for me, and I'll use it as my replacement property a year down the road, 2 years down. That brings up this, a whole. It's very, very interesting as we look at it and say, gosh, how is that going to change the nature? Going to be getting rather big. Look to take advantage of these tax mitigation opportunities.
Yeah, and if only it were so easy as saying, oh, gee, I like that property over there. I'll have James buy it, and he can just hold it for 5. But it is just a great planning opportunity that may be available to people. Do you know when what the appeal process is for this decision? Because I assume they're held by the government.
Yeah, and everything is going. And with a lot of other professionals in the in this arena. The kind of
the safe harbor,
standard non-safe harbor, if they're going to go over it, the safe harbor rules. But I think as time progresses, it's really going to kind of play itself out for sure.
Is there anything that you, based on the election, likely change in the 1031 arena?
So I think we've got what I would say the pie in the sky proposed legislation, right? And then we have my personal thoughts. So we'll go over this. So the legislation that the House Ways and Means Committee proposed was to repeal 1031 in full, right? And the effect of that would, I think, be bottom line $41 billion between now and 2023, right? So as we're looking at saving money, there's that. If you look at what the Senate proposed, the Senate is trying to say, well, what if we just do a $1 million, deferral cap per taxpayer? Also significantly affect my business and not be cool. But then E&Y actually did a study on what the scenarios, it would actually have a negative drain on the economy. So, I think it's going to be continued to be played out. I have always long thought that if there was going to be any tweaking within 1031, it's going to be more along the definitions and restrictions of real property, right? So as we look at personal property, which is probably a good segue in with Laura, personal property is very narrowly defined, right? If I have personal property like an airplane, I have to replace it with an airplane, right? Real estate, very broadly defined. Real property, I can go from a hotel to this office building, so forth and so on. It is to restrict the taxpayer from staying within that same general asset type would be something that would move the needle a little bit for people. So.
Thank you, James. Moving on to Laura and cost segregation. I'm probably not the only one in the room, Laura, who would like you to explain cost segregation for us and saving strategy.
Yeah, sure. So let's set the stage first. As we all know from our CCIM education, assets are depreciated over a long life. So 39 years for commercial properties and 27 and a half years for residential properties. And the IRS allows us to depreciate assets over shorter lives, depending upon the type of asset it is. So let me talk a little bit about cost segregation. So in a nutshell, it is a way to accelerate depreciation on a property or on a building so that you can lower your taxable obligation who have constructed, who have acquired or renovated property as far back as 1987 are eligible for cost segregation. It doesn't always make sense to go back to 87, but you're eligible, and I can kind of talk through how that works with each individual person. So let's talk about a cost segregation study. And the study is one where there's an engineer or somebody who's worked in the construction or real estate business, like reclassify them into different lives. 15-year land. And I'll talk about pictures of. The other question I get asked that is initial acquisition of that property, or you just finished constructing a new property, a new building. Some major tenant capital improvements, tenant improvements, could be leasehold improvements. Anytime you've had a major renovation to a property, it's important to classify that component or that element of a building. Also, another time to do cost seg is when there's a change in ownership. So, for example, I've inherited a property, or there's a change in partnerships and the partnership interests. And keep in mind, there's two groups of people that can do cost segregation. One is the owner either has to buy the building, they have to renovate the building, or they have to build it. Okay? Or if I'm a tenant, space, that tenant is also eligible to accelerate that depreciation. Okay? I get asked this question a lot. Well, Laura, I've already bought the building. I bought it 8 years ago. So did I miss my window? Did I miss my opportunity? And the answer is no, you have not missed your opportunity. There's the IRS allows us to go back as far as 1987 to do what's called a look-back study and catch up that depreciation in this current year of the study. And you can do that without having to amend tax returns. CPAs like that. It's by basically filing a 3115, which is a form that the CPA files.
Laura? Ag savings, property types.
Benefit. And before I do that, there's and a picture. So this asset can be broken down. So think about when you buy, you've got to have electric, you have to have plumbing. All of those are 39-year assets according to other components or other elements of a building that have shorter lives. For example, in this grocery store, you'll see lighting. Fluorescent lighting, and then you look to the side of the fluorescent lighting, there's track lighting. In this example, that fluorescent lighting is core, it's primary to the building, it's necessary, therefore it's a 39-year asset. However, that track lighting is secondary lighting, and therefore it becomes reclassified into the 5-year. The lighting, but the electrical elements associated with that lighting is also reclassified into the 5-year life. Another example is flooring. You look at the flooring on this picture, you've got vinyl flooring. Well, think about flooring you can have ceramic tile. In this room, we've got ceramic tile, we've got carpeting, and we probably have vinyl maybe somewhere. Ceramic tile is a 39-year asset. Carpeting and vinyl, they get moved into that 5-year bucket. Go to the next slide. I'll talk about, just to give you an example, and then I'll talk about pricing in a moment. You've got the parking lot, you've got curbing, you've got gutters, you've got signage, you have fencing, you have landscaping. You also have retention walls. All of that is a 15-year land improvement. It gets reclassified. Okay? So it's the same amount of depreciation over the life of that asset. It's just a matter of when you take the depreciation. It allows you to, you do not increase the depreciation, you're just accelerating it. And think about what we've learned in the CCIM classes. It's the time value of money. You know, if I can get the pot of money now, it's worth more to me now than it is in the long term, okay? So that's what the concept is behind cost segregation, it's about the time value of money. So Bill asked about the magnitude of benefits. The next slide, if you can go into that, is a case study. I've got some of them, more than one in your packet. I'm just going to go through one here. This is a new construction property. It is and it's brand new construction. It's about 8,200 square feet, sits on 1 1/3 acres of land, and it was a and as we know from our CCIM days, land is not depreciable. The cost basis of this asset is $2.35 million, and that's where we do the study on, is the value of that building and the improvements. At the end of the study, we were able to reclassify 32% into shorter lives, 5 and 15-year land improvements, and at the end of the day, what it means to that taxpayer is $166,000 in tax savings in that first year, okay? Over 5 years, net present value is a little over $200,000. So people often ask, well, what's this going to cost me? And if this is, you know, that's a pretty decent benefit. Cost is not based on the value of the benefit that the taxpayer receives or the property owner receives. The value or the cost is associated to the amount of time it takes for the engineer to do the study. He or she needs to go out to the property, do the site visit, and then they need to come back and write the report based on what the tax laws are associated with that property type. And that ranges anywhere between $4,500 and sometimes $25,000. So it's a pretty big range. This particular property, this was a Fresenius dialysis clinic in Decatur, Alabama, and it was a $6,000 study. So they paid $6,000 that first year. We have,
Yeah, we had talked about this before, whether or not there's like a sales benefit, so to speak, with cost segregation. Is there a way to make the acquisition more attractive?
yeah, so if you think about, how many of you attended the Atlanta Commercial Board of Realtors session? It was a couple weeks ago, and it was about the state of brokerage. It was really, really by being is a strategy that can allow that broker, because deal done, and the way you get a deal done is if you help them save, number one, save money, or number two, you help them in you can do here. And here is if you tell me just a little bit about your property, I can figure out what the potentials. You as the brokers in the room, can use that to show the potential buyer what is when you acquired that property. It's also true for on the tenant side, if you were to help a new tenant. But this is the potential savings that you could be entitled to as the buyer or the tenant. And this is, I just want to summarize with, we've been doing this since 2002, and we've done over 10,500 studies. We're a national company. Bedford Cost Segregation is across the country. I happen to be here in the regional office. But in our experience of doing those studies, the average results by property type is on the board here. So for example, if you're an apartment guy or gal, you can expect to see anywhere between 15 and 35% of that depreciation accelerated into shorter class lives. That's our experience. Well, let's say you're a shopping center. You have a shopping center. You're a shopping center broker or a shopping center owner. You can expect between 20 and 40% to get accelerated. Now, this is national averages based on doing 10,000 studies. The last thing I want to make sure we don't forget is the tenants. Tenant spaces. Tenants also qualify for cost segregation because if the value or the benefits follow whoever spent the money. So if the landlord spent the money, the landlord gets the value or the benefit. If the tenant spent the money, the tenant gets the benefit. And oftentimes, tenants like dentists, medical, restaurants, they tend to invest in the assets and provide TI dollars. So just wanted to leave you with that. And really, at the end of the day, the savings is going to depend on the date the property was placed in service, the type of used to the building itself, and then basically other facts and circumstances related to that taxpayer or that property owner and that property type.
Thanks, Laura. Moving on to Wayne. Wayne's going to talk about preserving capital gains on investment property development deal. So, Wayne, I believe it or not, I know that real estate sales can be taxed as ordinary income, or they can be taxed at capital gains, depending on a number of factors. and you sort of have a strategy that helps exploit that differential. Can you talk about scenarios where save capital gains?
How do you do this, James? Hello? We on? Okay. First of all, thank you all for coming here today. Thank you all for learning our parking lot and learning where we are. And we'll be glad to do this again so you can put that knowledge to all of us. I've been here for a while. We're still struggling with that parking lot. Well, feel bad. You just have to let yourself another couple minutes and just go straight to the 8th floor. Just go straight to the 8th floor. Okay, so I'm going to start on a timer here so we get back on, we stay on course. Maybe that'll take too long. It'll be worthwhile. Start. Bruce, I'm giving myself 8. And that may be a message to you all. It's only going to be 8 minutes. Okay, so you got a piece of property. You own a piece of property. It has appreciation in it. You would sell it at capital gain rates. Or, if that property is very suitable for a development where you would subdivide it either for commercial purposes or for residential purposes, you sold it, all that gain would be taxed as ordinary income. Big difference in the rates. So the question is, how do we carve out that appreciation, that pre-development appreciation? How do we carve that out so it gets taxed at capital gain rates, and only the value that's added after that, by virtue of the development, gets taxed at ordinary income rates? So it may be a piece of property that you own, and you think it's time to put it on the market, subdivide it, sell it. It may be a piece of property that you don't own, but you are a developer, and you see this piece of property as something that will be developed in, it might be a phase, the initial phase right now, and this may go on for years. And in the you do land banking. You're a developer, but you go out and do land banking. We don't see that much anymore because people don't really want to tie up property in land banking. Okay, so here's what you need to do. And some of this is because, like, the first thing I'm going to say is you need two entities. One entity is your investment entity, the other entity is your development entity. But the thing is that people don't really pay attention to the details, and the details are very important. This, and like a lot of other transactions, James is familiar with it. I'm sure, you know, all this and actions count. Here's what you need to do. We need to have the property initially owned by a company, and we'll just call it Invesco, not development code. If you're going to, if you want to treat it as an investment property, and we're going to have another company out there called Development Code. It's probably nice. You can call that Development Code. But these must be, and here's where the details come in. They must be separate from all, in all regards. And there's one person, I was talking about this in our office, and they said, if you don't respect the separateness of these two entities, the IRS certainly won't respect the separateness of the two entities. These lawyers here, if someone wants to get into trouble and they think they have liability protection and they haven't respected the separateness of the entities, you may have a problem there. So that means separately and adequately capitalized, separate financial records, documents, separate bank accounts, separate contracts. you need to respect the separateness when you sign a contract on investment code stationary. You can have identical ownership. A little bit of difference will help out a little bit, but you can have separate identity. They should clearly be an investor in the property. Elements come into play. Intent is what decides whether someone's an investor or a developer with respect to the tax treatment of these transactions. Intent is witnessed, it's evidenced by actions. So that means with respect to development property, very limited attempts, the number of sales, in your investment company office, don't have a bunch of plaques on the wall with development plans. Don't go talking about developing it on your investment. Might we get a little political here?
Website,
on your
yeah.
Investment.
There
You get the drift. Consistently refer to yourself as an investment company in your tax filings. Investment companies get treated on their tax returns a little bit different. Like, for example, your expenses get treated as itemized deductions. You know, you want to call on the tax return and tell them for investment. Things of that nature. So represent yourself as an investment company. Capitalized and all, you usually have to have a business purpose. I mean, why would you have these two entities owned by the same people? Why would you have these two entities owned by the same people unless it's just pure tax avoidance, which is a problem? Well, the reason is that it's been accepted by the courts is you're protecting the assets of developing property for sale. Now, one thing I did mention, in development code, you're free to do what I said to develop, subdivide, put in roads, the property. What's going to happen in investment code, you're going to have just a limited number of sales of large chunks of property to development code. You know, in development code, you can actively develop. One thing I must say is if your ownership is identical, it cannot be a partnership. This would be a flaw which will just destroy the whole what you want to do. This isn't subjective. This is if you sell from a partnership to a partnership and there's more than 50% ownership of profits and capital, is that is the character of the game with respect to development code will taint back to investment code. So you just said it was a corporation, elect that status.
So Wayne,
yes.
when you say has to be a corporation, you mean it has to be taxed as a corporation.
You got to organize as a corporation with the secretary.
You can see that's
yes, you can.
okay, and this I think highlights what's probably your big focus here, which is others.
Formalities count.
Yeah, formalities count.
Now let me just touch on one thing. The sale from investment code to development code, it must be on arm's length terms. It's recommended that I'm done.
Very good.
No, let me.
Very good.
Let me just touch on this. Will you? What do they do in Congress? Will you allow? Code to development code must be on arm's length terms, and the number one thing you ought to do is have an appraisal for that value. That you is overinflate that sales price to development code, so you carve out more capital gains.
Capital gains.
You should have an appraisal. There's a case, you quoted a case when, in the 1031 exchange. Bramlett's the case that we're talking about here. So everything must be done on an arm's length, and you must follow the terms. As lawyers will you must follow the terms. So if you say we're going to have payments at a certain time, we're going to have interest at a certain time, if the development code starts to default on these loans, then investment code ought to take action on it, because what will happen is that won't be treated as it'll be treated as a capital contribution to development code by investment code, at which time investment codes will blow the deal. I won't go, no need to go any further. I yield my time back to Bruce.
It's like a cliffhanger. That's like a little bit of a cliffhanger there. Okay. Thanks, Wayne.
You bet.
Now, we have a unusual opportunity here because we've already discussed one extremely recent and notable tax development with James and about valuation discounts and estate planning area that also, when I say this is a hot topic, I mean this is like electrified the estate planning world, that the IRS announced in early August that they effective December something of this year, and it has really had dramatic impact on a lot of estate planning, and Bruce is going to explain this for us. Well, he's going to try to explain it for us.
Thank you, Bill. Can you hear me? Yes. Good. I'm going to stand up because I like to see who I'm talking to, and I'm so short that there's no way I can do that unless I stand up. Bill, I'm really impressed with the tax knowledge you demonstrated up there just a few moments ago. Obviously, you've been hanging around the wrong people for the last 29 years and 10 months. Now that Bill's mentioned to all of you that I've been doing tax work longer than many of you have been walking, I want to address something. As Bill points out, everybody up to this point has given you very good information about income tax. This is a skipping tax. Now, a couple of years ago, they raised the exemptions roughly $11 million, and therefore very few people have to worry about the estate tax. But I bet you that most of your clients are those few people who do need to worry about it. And they need to worry about it in a big time because the estate tax is a 40% flat tax once you get beyond the $11 million. And so this is, the developments that have occurred are probably the most important changes to your clients that have occurred over the last 25 years. What has happened is that the IRS has proposed new regulations. Those new regulations happen to have some brand new concepts. They are proposed regulations at this point. They are not yet effective, and therefore there are things that you can tell your clients to do that will be very important. They will show that you are up on what's going on, and they will make a huge difference to your clients in terms. So this is very important. These regulations have come down in proposed form, and it's urgent that your clients take action as soon as possible.
So, Bruce, these people aren't estate planners. They're real estate professionals. Can you help us understand why this impacts real estate?
It impacts those who have family entities. That is, entities that are owned by family members. They may be transferring ownership interests to other family members, and when they do that, even as we speak now, they can take valuation discounts on the transfers of minority. Those minority interests lack control, marketability, and so those Those discounts are well recognized by the courts and therefore certainly by the taxpayers, and they have even been recognized by the IRS in its own revenue rulings. The IRS now is trying to step back from the issue, and they are trying to do that by attacking these valuation discounts. Though where people need to act now is if they have any intention on transferring ownership interest to other family members and want to do it at a favorable rate, because transfers are valued based upon fair market value, and if you can discount that fair market value, it means that you can transfer more property or transfer property with a much lower tax.
Okay, so we know that these regulations, I mean, just talking about the urgency for a second, we know that there's going to be this hearing on December. Nothing happens, and the hearing goes off. The regulations then become effective January, correct?
Well, there's a mystery about that, and the regulation to be a hearing on December 1st. The IRS is asking for comments. I know as of a couple of weeks ago, they had already received 30 comments, and I'm sure that those comments will accelerate as we get closer to December 1st. The IRS has said they will hold the hearings. They will then issue final regulations, and the final regulations will be effective 30 days after the regulations go final. So, at the earliest, it could be January 1st. Most people who have their ear to the ground in Washington think that it'll probably be sometime in 2017, maybe second or even third quarter. Some people are even predicting it'll take them much longer than that. We don't know what the final regulations will look like. We've got a hint. The advice is to act now.
But, and the act now means to enact estate planning or to enact provisions in the underlying documents that will do what?
Well, it's not only for people who are thinking about and people who are procrastinating because they're thinking about making transfers to other family members. They need to do it now, because if they do it later, they will do it under the shadow of these proposed regulations, which at that point will become final. Now, there's an additional question there, and that is, well, will those regulations be held up or not? And that's an open question. The courts have generally allowed agencies such as the IRS to promulgate regulations if there are issues about the law that are ambiguity. If the Internal Revenue Code doesn't really completely cover an issue, be contrary to the Internal Revenue Code itself. And in some of these cases, there are questions about whether some or all of these regulations will be held to be valid or not. But they will take action before the regulation. When they do that, they will currently exist. For you sitting out here, you can show your clients how knowledgeable you are, and you can get them to not only take action for themselves so they can save some significant amount of tax, but they need to start thinking about this.
And before I turn over to general questions, I want to ask you one more question, Bruce.
Sure.
What we're talking about is an extremely common estate planning technique, correct? I mean, this is not something that, you know, very few people would ever think about doing.
This is almost always done. As I say, up to this point, it's had even the IRS seal of approval. They came out with a regulation over 20 years ago that said that this kind of planning and this kind of valuation. But now, as I say, they're trying to backpedal. They have been talking about doing this for over 15 years. This goes back to the early part of the second Bush administration, and they've been talking about, we're going to come up with these proposed regulations. It's going to be in the next year, and year after year after year they said that, and they finally came out with those regulations again last month.
Okay. Well, thank you very much for that. So I would like to open up the floor for any questions to any of our panelists.
Bruce, you said that they need to do something now. $7 million.
Yes.
What do you suggest they do?
Well, people, there are
Real
several things that they could do. They could, at the very simplest level, they could say, okay, look, I'm going to give 10% of our property to the next generation, or to a grandchild's generation. That's the very simple thing they can do. They can also undertake other more aggressive techniques, such as grantor retained annuity trust. There are a lot of different things that they can do to even accelerate the amount of deductions that they're able to, or the amount of excluded transfers that they can make. That, in other words, transferring real value to a lower generation with paying either no tax. So really what it involves is people deciding to take action now, and many times it's action that they've been thinking about doing for years. Well, it's now time to stop thinking, time to start acting.
And by taking action, you mean other than dying?
Yes.
Yeah, okay, good. Any other questions? Joe?
Development Co. LLC. Separate. Is it problematic to potentially LLC or a member manager of the Invesco LLC? Is that, because oftentimes you see the manager of the LLC, let's make Development Co. manager, and it seems like that would be, from your example, problematic.
All right, keep in mind that we're going to have Development Code probably be a tax purposes. I mean, you went to the nuance of an LLC can elect to be treated as a corporation, ownership is the same. So, and then they can elect S status, and so it all flows through. That is not necessarily a problem. Keep in mind, arm's length, two separate entities, and if I were to take care of Bruce's entity and manage it, I would charge Bruce some money for that. I would have a contract or an agreement with Bruce to do that. And that would be acceptable. That would be fine. Question even with respect to, and this is getting down into some weeds, I think the management agreement is fine, but keep in mind the investment company is essentially a very low maintenance entity. So whereas you may want to acknowledge some activities performed by Development Code where all the staff may be, or you may even have a separate management code that's out there in your whole entity. Just use that independent third-party type of a mindset. Draw up the agreement and follow the agreement.
Another question. We had a question?
I know a simple example. Let's say you buy you own the first lien and the second lien, then you have to renovate the whole to either live in it or sell it at some point. So now there's three companies involved. The developer,
this strategy is not applicable to that scenario. This strategy is where you have, in one case, you've owned 100 acres for a long time, undeveloped, and you're going to then subdivide that property. Or, we're going to go out and we're going to buy a piece of property, and over the next 5-10 years, we're going to develop that property and sell it off in parcels as a dealer. What you may be, another topic related is people may buy residences that they're going to flip, which would be ordinary income property, and residents that they're going to buy and hold and rent. And in that case, think of these separate entities. That is your rent entity, and you should have an entity that is your flip entity. That's a different discussion though. Same rules apply.
Anybody else? Nancy?
This is for James. Are DST properties considered like-kind to commercial properties?
Gosh, I don't like the DST world.
You don't like it?
I think a lot of people do, but I would say, in general, I think a lot of people treat them as being like kind. I mean, it's very similar to looking at a tenancy in common structure, right? You just have to be cognizant of what additional risks, right, you're getting from the different benefits of having.
Let's qualify.
Hey James,
Well-
explain the DST property to us uninformed people.
I mean, I literally look at it like a TIC, all those. I mean, it's you're looking at a Delaware statutory trust is really what
that's what it stands
right?
for.
Is a DST. I know a lot of in that arena. We don't really touch them. I mean, I look at them and really treat them as a separate bird. So, I mean, I don't want to say that I'm completely unqualified to answer that question, but I don't play in that area, so I would.
Because I'm seeing that coming up a lot of times with,
Right.
they'll say this is a 1031 strategy.
Right.
And I didn't know if it was.
Because they're looking at it as a replacement property, just as you would a tenancy in
Right.
common
Yeah,
interest
I
within a
can't
certain
find something,
partnership.
why don't I put that as one of my identified
Right.
properties?
Right.
Did you see this on the internet?
Actually,
I'm a qualified intermediary. I structured as a trust, and similar to the TIC. Rather than having 35 separate loans, you have one loan. It's a beneficial interest, and it is like kind. So,
oh, good.
yeah.
So it does well. Okay, cool.
Oh, and my name's Whitney Brennan, by the way.
Good to see you.
Do we have anybody else? Well, I'd like to thank everybody for their presentations today.
Thank you, everyone, for being here today. Thank you to our wonderful panel. That was awesome. Thank you to Warren Averett and Kitchens Kelley Gaynes for sponsoring today's program. Remember to register for the College Football Hall of Fame in October, and we'll see you next time. Have a great day.
Thank you.